There's a threshold in wealth building that almost nobody talks about, but once you cross it, everything fundamentally changes, not gradually dramatically. I'm talking about $20,000 in investable capital, and I don't mean 20,000 in equity trapped in a house or in a retirement account you can't touch for 30 years. I mean $20,000 in liquid capital that you control and can deploy. I'm Raoul Pal, and over the last 3 decades, I've watched thousands of people try to build wealth. I've advised institutions managing billions, I've built and sold businesses, and I've studied the behavioral patterns that separate those who achieve financial independence from those who stay wrapped in the cycle of paycheck to paycheck survival, and what I've learned is that there is a specific inflection point where the mathematics and psychology of wealth building completely transform. Most people never reach this point. They get close, maybe they accumulate $5,000 or 1,000, and then something happens. An emergency, a temptation, a moment of impatience. They spend it, they lose it, they give up, and they reset to zero, never understanding that they were right at the edge of the breakthrough. Today I'm going to explain exactly why $20,000 is the threshold, what changes when you cross it, and why most people sabotage themselves right before they get there. Because if you're earning a modest income, living in an expensive world, and wondering whether financial independence is even possible for someone like you, you need to understand this concept. It might be the most important financial lesson you ever learn. Let me start with a truth that the financial industry doesn't want you to know. Wealth building is not complicated. It's not about secret strategies or insider information or complex derivatives. It's arithmetic. Pure, simple, boring arithmetic. And the arithmetic shows that everything works differently once you have a certain amount of capital. But before we get into the math, I need to address the psychology, because this is where most people fail. The early stages of wealth building are brutally slow. You save a few $100s a month. You watch that number grow incrementally. Meanwhile, everyone around you is buying things, new cars, vacations, the latest gadgets, and you start to feel like the fool, like you're sacrificing for nothing. This is the moment where most people quit, right here. The thinking is completely wrong, and this error, this fundamental misunderstanding of how compound growth works keeps more people poor than any economic system, any unfair advantage, any rigged game. They're thinking linearly when the process is exponential. Let me explain what I mean. When you're starting with nothing, saving $400 a month, you're doing all the work. You're the engine. Your money is just sitting there, barely contributing. After a year, you might have $5,000. A 10% return on $5,000 is $500, barely noticeable. You sacrifice for 12 months, and your money contributes $500 while you contributed $4,800. You're carrying the entire load. This is the flat part of the exponential curve. It looks like nothing is happening. It feels pointless, but the curve isn't flat, it's building potential energy. And if you quit now, you never get to see what happens next. Here's where it gets interesting. At $20,000, something shifts. A 10% return on $20,000 is $2,000. Now your money is contributing meaningful value, roughly half of what you're saving from your income. You're no longer carrying the full load. Your capital is starting to work. At $50,000, a 10% return produces $5,000. Your money is working as hard as you are. At $100,000, the return is $10,000. Your capital is now generating more than you can save from a typical salary. The snowball is rolling, and it's building momentum. This is the exponential part of the curve, and nobody gets here by quitting during the flat part, but that's exactly what most people do. They quit when they're doing 100% of the work, never realizing that if they just pushed through, their money would start carrying the weight. The $20,000 threshold is where this transition becomes visible and real. Before that point, the returns are theoretical. You know, compounding exists. You've seen the charts, but it doesn't feel real because the numbers are too small. But at $20,000, you can see it in your account. You can see your capital generating returns that actually matter, and psychologically, that changes everything. Let me talk about the identity shift that happens at this threshold, because this might be even more important than the math. Below $20,000, you still see yourself as someone who's struggling to save. Every dollar requires effort. Every month you're vulnerable to setbacks, a car repair, a medical bill, an unexpected expense. You're one emergency away from being back at zero. But once you cross $20,000, your identity shifts. You're no longer someone who can't save money. You have proof that you can do this. You have a cushion that creates breathing room. You're not one bad month away from disaster. And that psychological shift is massive. It changes how you think about risk, about opportunity, about the future. Options that were invisible before suddenly become visible. You can take a calculated risk on a side business because you have a safety net. You can invest in an opportunity that requires capital because you have capital. You can negotiate from a position of strength because you're not desperate. Capital attracts opportunity, and opportunity generates more capital. It's a virtuous cycle, but you can't enter that cycle without reaching the threshold first. Now let me talk about the mental errors that trap people below this threshold, because understanding these errors is critical. The first error is impatience. We live in a world of instant gratification. You can order something online and have it delivered in hours. You can swipe through infinite content on your phone. Everything is fast, immediate now, but wealth building is slow, especially at the beginning. And if you can't tolerate delayed gratification, if you can't sit with discomfort, if you can't watch your neighbors buying boats while you're driving a 10-year-old car, you will fail. The person who could have been financially independent at 50 ends up broke at 50 because they couldn't tolerate being less flashy than their peers at 30. I've seen this pattern destroy people who had every advantage: high incomes, good educations, strong networks. They earned plenty, but they spent more. They scaled their lifestyle to match or exceed their income, and they never built capital. Meanwhile, I've seen people earning modest salaries achieve financial independence because they consistently spent less than they earned and invested the difference. The arithmetic doesn't care about your job title or your tax bracket. It only cares about the gap between what you earn and what you spend, and what you do with that gap. The second error is envy. This is the killer. You're making progress, you're saving money, you're doing everything right, and then you see someone else getting rich faster than you. Maybe it's a friend who got into crypto early. Maybe it's a colleague who got stock options that exploded. Maybe it's someone on social media showing off their lifestyle. And suddenly your plan feels inadequate. You start questioning whether you should abandon your strategy and chase whatever they're doing. You start taking risks you don't understand to try to catch up. Or worse, you start spending money to prove you're not falling behind, destroying your own progress to match someone else's highlight reel. Here's what you don't see: the full picture. The person with the new car might be financing it at 12% interest. The colleague with the big house might be leveraged to the breaking point. The friend who got rich quick might be about to lose everything on the next trade. You're comparing your behind-the-scenes reality to their curated public image, and it's making you miserable. I learned this lesson early in my career. Nobody gets my envy. I don't care what someone else has. I don't care if they made money faster than me. My only competition is my past self. Am I better positioned today than I was a year ago? That's the only metric that matters. When you stop measuring yourself against others and start measuring yourself against your own plan, your own goals, your own timeline, the psychological pressure evaporates. You can be genuinely happy for someone else's success without feeling diminished. You can stick to your strategy without second-guessing every decision. This mindset alone is worth millions over a lifetime. The third error is self-pity. Look, life is hard. Everyone faces setbacks, obstacles, unfair situations. Maybe you started with nothing. Maybe you had bad luck. Maybe you made mistakes early on that set you back. All of that might be true, but self-pity doesn't help. It paralyzes you. It makes you a victim when you need to be an agent. The most powerful mental model I know for building wealth is inversion. Instead of asking, what do I need to do to get rich? Ask, what guarantees staying poor forever, and how do I avoid those things? The answers become obvious immediately. Spending more than you earn guarantees failure. Not saving anything guarantees failure. Taking on high-interest consumer debt guarantees failure. Being unreliable, showing up late, breaking promises guarantees that nobody wants to work with you or promote you. Using substances that impair your judgment guarantees you'll make bad decisions. Feeling sorry for yourself guarantees you'll stay passive when you need to be active. Once you've identified all the behaviors that guarantee failure, the strategy is simple. Don't do those things. You don't need to be brilliant. You just need to be consistently not stupid, and that's harder than it sounds, because humans are wired for short-term gratification, for social comparison, for emotional decision-making. Let me give you a framework for actually reaching that $20,000 threshold, because understanding why it matters is useless if you don't know how to get there. First, you need to create a gap between your income and your expenses. This is non-negotiable. If you're spending 100% of what you earn, or worse, 110% by going into debt, you will never build capital, ever. For most people, this means either earning more or spending less, ideally both. On the income side, you need to become more valuable. You need skills that the market will pay for. You need to be a learning machine, constantly improving, constantly adapting, constantly expanding your capabilities. The people who rise in life are not always the smartest or the most talented. They are the ones who go to bed every night a little wiser than they were when they woke up.
On the expense side, you need to be ruthless about differentiating between needs and wants. You need housing, food, basic transportation, healthcare. Everything else is discretionary. I'm not saying live in poverty. I'm saying every dollar you spend on things you don't need is a dollar that can't compound for 20 or 30 years. That's the real cost. Once you've created the gap, You need to automate the savings. Set up an automatic transfer on payday. The money moves into your investment account before you see it, before you can spend it, before you can rationalize why you need it for something else. You're eliminating willpower from the equation. You're making the default behavior the right behavior. Then you need to invest that capital in productive assets, not a savings account earning 0.5%, not cash under your mattress, assets that generate returns, stocks, index funds, ETFs that give you exposure to global growth. For most people, a simple portfolio of low-cost index funds is perfectly adequate. You don't need complexity. You need consistency. And then, and this is critical, you need to leave it alone. Don't trade. Don't try to time the market. Don't sell when things get scary. The big money is not in the buying or the selling. It's in the waiting. It's in letting compound returns do their work over years and decades. Every time you sell an investment that's working, you pay taxes. Every time you pay taxes, you have less capital compounding. Every time you interrupt the compounding process, you set yourself back. The first rule of compounding is to never interrupt it unnecessarily. Let me talk about time horizon, because this is where people get the math completely wrong. They think linearly, if I save $5,000 a year, in 20 years I'll have 100,000. But that's not how it works. If you save 5,000 OLOs in a year and earn 8% annual returns, after 20 years you don't have 100,000. You have over 240,000. The returns on your returns are doing most of the heavy lifting in the later years. The first 20 Valorzarosen might take you 4-5 years of disciplined saving. It feels like forever. But the next 20 Zausen comes faster because your capital is working. And the 20 Zausen after that comes even faster. By the time you get to 100 Zarosen, the momentum is undeniable. You're watching your account grow by thousands per month from returns alone, not just from savings. This is why starting early matters so much. It's not just about having more time to save. It's about giving compounding more time to work. The difference between starting at 25 and starting at 35 isn't 10 years of savings. It's 10 years of compounding. And that difference could be hundreds of thousands of dollars. Let me address something that I know is going through your head right now. You're thinking, Raoul, this sounds great, but the world is different now. It's harder. Previous generations had it easier. You're right. It is harder now. Competition is global. Technology is disrupting industries. The cost of living has outpaced wage growth in many places. I'm not denying any of that. But harder doesn't mean impossible. Harder just means you need to be better. You need to adapt faster. You need to learn more. You need to be more disciplined. The fundamental arithmetic of wealth hasn't changed. Compounding still works the same way. The psychology of success, patience, discipline, continuous learning still works. The people who build wealth in this generation will be the ones who accept that it's harder and execute anyway. They won't waste energy complaining about unfairness. They'll focus on what they control, their skills, their spending, their investment decisions, their mindset. Now, let me tell you what happens after you cross the 20,000 threshold, because this is where it gets exciting. Capital attracts opportunity. Once you have 20 Lalosen, a 30 Zarosen, a 50 Zarosen, opportunities that were invisible before suddenly appear. Someone approaches you about investing in a business. A real estate deal comes along that requires capital. You can take advantage of market dislocations that people without capital can't touch. I've seen this in my own life repeatedly. The early years were about building that initial capital base through discipline and sacrifice. But once I had capital, the opportunities multiplied. I could partner on deals. I could invest in early stage companies. I could take calculated risks that someone living paycheck to paycheck couldn't even consider. The rich get richer not primarily because the system is rigged, though there are certainly advantages, but because having capital allows you to make more money. Your job is to get enough capital to enter that virtuous cycle. And 20,000 is where you begin to see it and feel it. Here's the other thing that changes your relationship with risk. When you have no capital, you can't afford to take any risk. You need every paycheck. You have to take whatever job is available, work for whoever will hire you, tolerate whatever conditions exist. You're not living your life. You're living whatever life your financial situation allows. But when you have capital, when you have that cushion, you can afford to be strategic. You can say no to opportunities that don't align with your goals. You can wait for the right opportunity. Instead of grabbing the first one, you can negotiate from strength instead of desperation. That optionality, that freedom to choose, is what capital gives you. This is why I was so passionate about building wealth early in my career. Not because I wanted fancy cars or big houses. I wanted independence. I wanted to wake up every morning and make my own decisions without asking anyone's permission. I wanted to build something on my own terms. And money was the tool that brought that freedom. Let me give you some specific numbers to make this concrete. If you're 25 years old and you save 500 a month, 6 wazos in a year, and you invested at an average 8% annual return, by age 35, you'll have about 95 zalozen. You've crossed well past the 20 zalozen threshold. The momentum is building. Your capital is working. If you keep going with that same discipline, by age 45, you'll have 370,000. By 55, you'll have 930,000. By 65, you'll have over 2 million. You retire a multimillionaire on a very modest salary, not because you did anything complicated, but because you started early, you stayed consistent, and you let compounding do its work. But here's the brutal truth. If you start at 35 instead of 35, those same contributions only grow to about 1 million by age 65. You've lost $1 million by waiting 10 years. That's the power of time in compounding. That's why crossing the 20,000 threshold as early as possible is so critical. Now, I want to be very clear about what not to do once you start building capital, because this is where people blow up their progress. Do not use leverage aggressively. Do not borrow money to invest. Do not buy stocks on margin. Do not finance speculative investments with debt. Leverage magnifies returns when things go well, but it magnifies losses when things go badly. And when you're using leverage, you don't get to control the timing. A margin call can force you to sell at the worst possible moment. A leveraged investment gone wrong can wipe out years of discipline saving in a matter of weeks. I've seen so many smart people destroy themselves with leverage. They get impatient. They want to accelerate the process. They borrow to invest, and for a while it works beautifully. They feel like geniuses, and then something goes wrong, and they lose everything. You only need to get rich once. You don't need to get rich 4 times. Building wealth slowly, without leverage, without catastrophic risks, means you only have to do it once. And once you're there, nobody can take it away from you. Let me close with this. The gap between staying broke and building real wealth is smaller than you think. It's not about your starting salary. It's not about your family connections. It's not about getting lucky with one investment. It's about the discipline to save consistently, the patience to let compounding work, the wisdom to avoid stupid mistakes, and the persistence to keep going when progress feels slow. The 20 zalzozen threshold is where all of this starts to click, where the math becomes visible, where your psychology shifts, where opportunities begin to appear. Everything before that is laying the foundation. Everything after that is building the structure. If you're below that threshold right now, understand that you're in the hardest part, the flat part of the curve, the part where you're doing all the work and your money is doing almost nothing. Most people quit here. But if you can push through, if you can maintain discipline for 3, 4, 5 years to cross that threshold, everything changes. You're not trying to get rich quick. You're trying to get rich slowly and reliably. You're playing the long game. And in the long game, the person who can delay gratification, who can ignore envy, who can avoid self-pity, who can stay patient, that person wins. If this resonates with you, if you're committed to crossing that threshold, leave a comment and tell me where you are right now. Are you building toward 20T the Olosen? Have you already crossed it? What's been the hardest part for you? Share this with someone who needs to hear it. And subscribe, because we're going to keep breaking down the frameworks for building real wealth in a world that's constantly trying to separate you from your money. The path is simple, not easy, but simple, and it's available to anyone willing to do the work. Now go execute.